Hi everyone, it's Paul Tilley and welcome back to AC1260 Financial Accounting 1. Today I'm looking at Unit 2, which is Analyzing and Recording Transactions. Just in terms of a background before we begin, when you think of transactions, these are the events that happen in a business that have financial implications. So for example, when the business generates revenue, someone comes in and buys something. Or for example, when the business goes and buys some inventory. These are all considered as transactions, and that's what the accounting does, is it records these transactions. The system works by recording the transactions for a year, okay? The system works by, if we know what the start situation is with the financial information, and then we record the financial changes that occur over a period of time, usually 1 year, we can then, at the end of that year, assess what the financial situation is again. So effectively, we take a picture at the beginning of the financial situation, assets, liabilities, owner's equity. That's what the balance sheet is, a snapshot of the financial situation. Then during the course of the year or the time period involved, transactions occur. Things get bought, things get sold, we buy things, we add things, these sorts of things. Those things are recorded during the year, and at the end of the year, we do an assessment of where we are. What are the assets, liabilities, and owner's equity at the end? So this is what we call the accounting cycle. So the whole purpose of this unit is to look at how we use the various tools in accounting to record during the accounting cycle. So the key unit objectives here are going to be explain what the accounting cycle is, describe the concept of an account and how it's used in relationship to a book of accounts called the ledger. We're going to define things called debits and credits and their use in what's called double entry accounting. We're going to describe the chart of accounts, which is all of the accounts in a business, and their relationship to the ledger. And we're going to analyze the impact of transactions on these accounts, such as what we do when we record transactions in a journal and post these entries to the ledger. So, and then we're going to prepare and explain the trial balance, which is used in order to complete the accounting cycle and build the next balance sheet for the company that would occur at the end of the accounting cycle. So what exactly is the accounting cycle? Well, the accounting cycle is a collective process of identifying, analyzing, and recording the accounting events of the company that occur during a defined period, usually 1 year. And I can't overstress the fact that it's an accounting event. It has to affect the assets, liabilities, and owner's equity of the business. So we need to assess, is this an accounting event? When an event occurs, we need to assess, is it an accounting event or not? Accounting events get recorded. It is made up really of 8 steps. So the process begins with the actual transaction and ends with the inclusion in the financial statements. So the key steps in the 8-step accounting cycle include recording journal entries, posting it to the general ledger, calculating trial balances, making adjusting entries, and creating the financial statements. You will see here in this particular graphic, it lays out what we're going to be doing during this course in terms of looking at those 8 steps. So the remainder of the course is really focused on these 8 steps. So you'll see, for example, analyze transactions are what occur in chapters 1 and 2, which is units 1 and 2 in this course. In chapter 2, we're looking at journalizing, which is what we're going to do here, and posting and preparing an unadjusted trial balance. So those are the things we're looking at in this particular section right here. Chapter 3, we're going to look at making adjustments to that because every once in a while things need to be adjusted. There are errors made or maybe some event has occurred that has to result in some changes. We're also going to look at preparing an adjusted trial balance, which is after the adjustments are made to the trial balance, we're going to prepare an adjusted trial balance. And from there, we're going to prepare the statement. So really that's going to include chapter 4, but it includes really all the material from 1 to 4. And then we're going to look at the closing entries and finally preparing a post-closing trial balance. So What we're doing in really these first 4 chapters is this initial part of the accounting cycle. In the remaining of the course, we'll finish off the accounting cycle. Just to refresh your memory from chapter 1, the fundamental accounting equation is assets equal liabilities plus owner's equity. Or more simply, what the business owns, its assets, must equal what the business owes, its liabilities, which are what it owes to outsiders of the firm, and its equity, what it owes to the people who own the firm. Keep in mind the entity concept. So a firm is a separate entity. So the equity is considered as what it owes to its owners, okay? If you combine the assets with the liabilities and the owner's equity, they will balance. It will always be in balance. So assets will always equal liabilities plus equity. The first issue that we really need to get a good handle on is the issue of what is an account. So an account is a detailed record of increases and decreases in a specific asset, liability, or equity item. So that account is really an accounting of the increases and decreases in a specific asset, liability, or equity item. Okay, so we can think about what are some of the accounts you will find. Well, you think about in assets, for example, a common item would be cash, or notes receivable, or supplies, or furniture. It's stuff the business owns, okay? It falls under the category of owns. So when you look at an account, if you have to figure out what an account is or where it fits there, you want to ask, does the business own this? Does it own cash? Does it own notes receivable? Does it own supplies? Does it own furniture? Yes. Accounts for liabilities, typical ones would include accounts payable and notes payable. These are payables, meaning that they're owed outside the firm. It's something that we have to pay later on, or the business has to pay later on. So these would be considered as liabilities. And equity usually includes a couple of key things. First of all, the capital, which is the amount the owner puts into the business, okay? And it would also include things like when the owner takes things out or withdraws, takes away from business. And revenues add to the equity. So if the business makes money, it gets added to the value of the business. So service revenue and rental revenue would be considered under the broad category of equity, whereas expenses take things away from the business, so those would be considered under the broad category of equity as well. The ledger used to be a book, but it's really a record containing all the accounts used in the business. Years ago, the ledger used to be a booklet called the ledger book, and in the ledger book, it would contain pages, and each of the pages would have an account on it. So, for example, cash. And it would record the comings and goings of cash as accounts receivable, and so on. Most of the time now, ledgers are electronic, meaning that it is the same process. It tallies the brought into the account and taken away from an account to get an account balance. Ledgers for each individual company are unique, meaning that every company would have a different concept of what exactly is the total amount of assets or what exactly is the amount of owner's equity. So every single ledger would be different, so it's unique to the firm. One of the ways that we can best record changes in an account is by using something called a T account. And the T account is simply, as the name implies, it looks like a T. On the left side, it's a debit side, and on the right side, it's a credit side. So a T account represents an account in a ledger, and the T accounts are used really as a learning tool. When you do this online, you don't actually see T accounts, but when you do it manually, like we're going to do here, the T account is very important, and it gives you a good understanding of how this system works. So the difference between the debit side and the credit side is the balance in the account. So let's say, for example, that we have the account cash, okay? Basically, the debit side would be additions to cash. And the credit side would be deductions from cash. So as we add cash items in, as cash came into the business, it would get recorded on the left side of the account. And as cash would move out of the business, it would be recorded on the right side of the account. If we tally the two we would see a difference in them. The difference would be the balance in that account. So here's an example of the account balance here, and you can see that cash, for example, is the T account we're looking at. There was a cash sale, the owner put money into the business, investment. So there was a total inflow of $1,500 into the business. The outflow was, well, there was $325 paid out in salary and $450 paid in rent for a total of $775 paid out. So the difference between the money that came in, $1,500, and the money that went out, $775, was $725. So there's a positive balance in the account of $725. So it would get reflected on the debit side because it's an asset account, and that would be considered a debit in that case. In other words, there's $725 in the account. We use what's called double entry accounting in accounting, and effectively what that means is that transactions are recorded using debits and credits. So every transaction affects at least two accounts. There could be more than two, but at least two accounts are affected. So equal debits and credits will keep the accounting equation in balance. So you would think that the debit side and the credit side must equal whenever we look at an individual entry. So here's where it gets confusing for a lot of students, but this is an important thing to remember, okay? We need to be able to think assets, liabilities, equity. At assets, debits increase the account. Credits decrease the account. The opposite is true for the other side of the equation. So if we think about the other side of the equation being liabilities and equity, debits decrease and credits increase. So that's something that you really need to focus on in accounting first. And that is probably the thing that causes people the most confusion. Okay, so assets, debits increase it. Liabilities and equity, debits decrease. You can see a full version of that right here. For example, one of the things that always used to confuse me earlier on was the issue of revenue expenses. You know, that these are the ones that are a little more complicated. Well, a revenue and an expense, as we've seen, is really part of equity. Okay, really under the equity section. So we think that as we look at revenues as they go down would cause a debit decrease, and expenses would cause a debit to increase. So this is something you really need to practice and think about. So if I were asking you to figure out something in this chapter, this would be the most important thing, because that's fundamental to our understanding of a double entry accounting system. You have to get this. So you really need to think about and study this and understand the implications of a change in the account. So if we were to ask ourselves, you know, what are the normal account balances? Well, assets, withdrawals, and expenses are normally in debit balance, and liabilities, owner's equity, and revenue are normally in credit balance. Next, we have to consider what we mean by the chart of accounts. Well, the chart of accounts is, as the name suggests, a chart that contains all of the accounts. So it's a list of all the accounts used in the ledger by the company. So you could think that a company will have many accounts. It will, you know, depending on the size of the company, there could be hundreds of them. But effectively, when we design our accounting system, we need to think, what are the things we're going to buy and what are the things we're going to sell? What are the assets? What are the liabilities? What are the owner's equity? We would build our chart of accounts based on that. If we were to look at some basic examples here, you know, this little mini quiz, indicate whether the debit or credit is needed to increase a rent expense, okay? So when we think about a rent expense is an expense. And we know that as expenses occur, they go in debit. A decrease in accounts payable, well, an accounts payable is a liability, and a decrease in a liability is a debit. A decrease in accounts receivable. Well, an accounts receivable is an asset. That would be a decrease in an asset, and a decrease in an asset would be considered a credit. A decrease in cash. Cash is an asset. As it goes down, that would be a credit. An increase in withdrawals. So, for example, the owners take money out of the business. That would reduce the owner's equity, and that would be considered a debit. We'll look at the first 4 steps in the accounting cycle here. The first step really is analyze the transactions based on the source document. So that's kind of looking at what's happened and determine, is this an accounting event? And second of all, what are some of the issues with regards to it? What's being debited? What's being credited, for example? Then we're going to record the journal entry. Then we're going to post the entry to the ledger. And then we're going to prepare the trial balance. So for the purposes of this, what we're looking at are these first 4 stages, okay? So let's look at the very first stage by way of example. The very first thing we need to do is to think about, what do we need to do in order to analyze transactions? Well, what we need to do first is to determine what accounts exactly are being affected. So the next thing we need to do is determine if the account has increased in balance or decreased in balance. So for each of the accounts, what's happening? And then we have to apply the rules of debit and credit. So let's look at our first example. The owner invests $10,000 cash in the business, okay? The owner puts $10,000 into the business. So let's think about it. Well, what have we got going on here in terms of the various accounts? Well, first of all, there's $10,000 cash. So we ask ourselves, the cash account is being affected. How is it being affected? It's going up. The owner put $10,000 into the business in cash. Cash goes up. The other thing is that the owner invests. That would be considered as owner's equity. Okay? So I think the specific account would be capital. So what we're saying is that goes up by $10,000 too, because the owner now is owed $10,000 by the business. So the accounts affected would be cash and capital. So we see here that these two would be the key ones affected. So what happens to cash? It increases. And what happens to capital? It increases. So an increase in cash would be a debit, and an increase in capital would be a credit. If we move to our transaction then, the owner invests $10,000 cash in the business. Our cash account will go up by $10,000. So we'll get out our T account and we'll add $10,000 to the left-hand side, which is the debit side of the cash account. The other account that's affected, so we'll look at our T account for the capital, for Walker. Well, that account goes up by $10,000, and we know that an increase in capital is a credit, so that account would increase by $10,000. Let's look at another example. The company purchases supplies by paying $2,500 cash. So we ask ourselves, what's going on here? Well, supplies are affected, so there will be an account for supplies, and there would be an account for cash, okay? So those are really the two accounts. So the supplies, we think about supplies, that goes up, doesn't it? The amount of supplies go up, and the cash would go down because we spent $2,500. So effectively, supplies would increase by $2,500, and cash would decrease by $2,500. So supplies and cash would be the account, and we would see supplies would increase, cash would decrease. Let's think about what that is in terms of debits and credits. Well, supplies is an asset. It would be considered under the asset column, and an increase in an asset is a debit. Cash is also an asset, and it is decreasing. A decrease in an asset is a credit. So what we would end up doing is in our T account, we would put supplies account. We would add $2,500 to it on the debit side. And in our cash T account, we would add $2,500, or subtract, I should say, $2,500 to the credit side. So that would effectively cause a reduction in cash. Let's look at another example. The company purchased supplies for $1,100 for credit. So the thing is, when we look at this one, it's very similar to the second one. We have supplies coming in. So again, based on our experience number 2, We have an increase in supplies. Supplies is an asset. That is $1,100 debit. Now, for it's sold on credit, meaning we haven't paid for it yet. It would be what we would consider an accounts payable. Accounts payable is whenever we take on a credit. Basically, we're going to pay something on credit. The account that's used is a liability account called accounts payable. And what we're going to see is that our accounts payable account, a liability account, would go up by $1,100. So supplies and accounts payable would be the accounts affected. We would see supplies increase by $1,100, and we would see accounts payable increase by $1,100. Supplies is an asset account. An increase in an asset is a debit. Accounts payable is a liabilities account. An increase in a liability is a credit. So we would put it in our T accounts as supplies debit for $1,100 and accounts payable credit for $1,100. Let's look at example 3B. So 3 was the first part of this particular transaction. 3B is the second part of this particular transaction. So the company goes on to purchase equipment for $6,000 on credit. Well, okay, so our equipment is an asset that's going up, so that's debit of $6,000. And normally when we buy something fairly large, like a piece of equipment, we have a longer term payable. That's a little bit different than accounts payable. Accounts payable is short term. A notes payable is usually used for a longer term loan. So let's assume that the loan on this is longer, the longer payment. So let's say that this is going to be a notes payable for $6,000, and notes payable will be in credit. So combining these into the general journal then would say, okay, let's take that and record these. So here's the date. First of all, you see the date, and we got number March 1st, and account titles, well, cash. And normally what we do is we put the debit on top, okay? So cash and the debit, $10,000. Tilley Walker Capital, credit, $10,000. So what we see is debit and credit reflected here. The two are in balance. The next thing we bought was some supplies for cash. So normally debit's on top, $2,500 debit, cash, $2,500 credit. And normally we have a little explanation on the bottom, purchase supplies for cash. Finally, we bought some equipment, and so asset would be supplies, $1,100, and the second component of that was the equipment we bought. Effectively, there were two A and B, 3A and 3B. So supplies went up by $1,100, equipment went up by $6,000, and accounts payable $1,100, and notes payable $6,000. That could be broken into two separate entries, but what we're considering, seeing as 3A, 3B, is we must have done that as one single event. The general journal information is really transferred then to the general ledger, and the account balances are updated, and this process is called posting. And normally this is done on computer these days. So let's take a look at this. Okay, here's the posting process. Here's the general journal that we just looked at for the first entry, cash and Tilley Walker Capital, $10,000. So we go to the ledger for cash, and we see $10,000 debit or an addition of cash. So this is recorded in. And we go to the capital ledger, and we would see that the $10,000 brought in capital, that's $10,000. So effectively what we're doing is taking this amount out of book number 1, which is the general journal, and posting into the ledger, which is the individual accounts for each of these ones. That would be how you process that. Once we've posted them all into the various ledgers, we go to create what's called a trial balance. Once we've done all the postings for a period of time, then we look at and say, what are the balances in each of the accounts? And let's list them. So effectively, a trial balance is a listing of all the balances in the accounts. So the cash, for example, will have a debit balance of $80.70, and so on. And when we're done with this, we should, and we must, have the debits and credits in balance, because assets equal liabilities plus owner's equity. So that's how this initial process takes place.